Hello people, this is Dr. Long here recording. This is your quiz number 10 and it is about free cash flow analysis, which is fairly important to estimate the value of a firm based on their business. So right here you have a candy shop. Okay, they are establishing a new production line, and so here are the numbers, and you are going to estimate the project NPV, based on the financials, and also the project IRR. So it is a very typical question to get the value for the firm, and that value can be used for selling the shares, like raising private equity or issuing new shares in the IPO or SEO market, or just simply raise capital from the debt holders. So the setup of this quiz is actually fairly easy if you have taken corporate financial practice class with me. If not, still I will walk you through this quiz. You know that throughout the whole semester you have 12 quizzes, and 2 of the quizzes you score the lowest will be automatically dropped. So this quiz is easier, not because the setup is simpler, but also because I make this video to help you through this, and hopefully you can boost your overall grade by successfully finishing this quiz. Alright, so one thing you're gonna do, of course, you need to use an Excel file. Alright, and this Excel file will be the file for the capital budgeting table, and based on which you will develop the NPV and IRR. So the cost of the machine is listed here. Okay, that's $80,000, and it has an ending book value of $20,000. So let's just put it here, 80,000 and 20,000 for ending book value. And the machine lasts for 3 years. So a life is 3 years because it's produced for food. And then you can get the annual depreciation based on the numbers. So you will use the beginning value, which is the cost of the machine, minus the ending book value divided by 3. Alright, so 20,000 is the annual depreciation. And you can just change the format a little bit, put a dollar sign in front of it, try to make it look more professional. Alright, the next thing is the factory will sell the machine 3 years afterwards on the salvage market, and the $30,000 is not the $20,000 as mentioned here. So there's a capital gain being made, and the IRS will not let you go for free. So the actual salvage is $30K, all right, and then you actually make a capital gain. All right, so you use a 30K minus this 20K you reported to IRS, and you will pay capital gain tax on it. Alright, the tax rate is 40% here, so you just use the 40% multiplied by these capital gains. Alright, so that's the numbers incurred at the beginning of the project or at the end of the project, except for annual depreciation. And right here, you can create your capital budgeting table. You have year 0, 1, 2, and 3. Alright, and you have the capital expenditure for buying the old machine, and that's a negative number of the $80,000 cost. Alright, and then you can put the sales for each year, and right here is telling you the sales is at $75,000 every year with the 40% variable cost. Okay, so you can just copy and paste the $70,000, but put it in year 1 instead of year 0, and then you just drag it all the way. Alrighty, and then you can calculate the variable cost. The variable cost is 40% of the sales of the year, and that's fairly straightforward. And use Format Painter. I don't like this big number. Okay, make it smaller. Alright, you also have a fixed cost. The fixed cost is $10,000 each year. So nice and easy, just put the numbers there and then just drag the numbers. All right, and also I want a format painter to duplicate the same format for different numbers, different cells. And you also have annual depreciation, and you just simply copy the number there and make sure you lock it before you drag it. Alright, and based on all the numbers here, you can calculate the EBIT. Alright, so the EBIT is called earning before interest and taxes, and you will use the sales minus all of these expenses, variable, fixed, and depreciation. So that's your EBIT. Even though it's the earning before interest and taxes, for capital budgeting analysis, we do not incorporate interest because that's a financial cost, and we will put interest somewhere else, okay, but not here in the cash flow calculation. And then you will need to calculate the taxes you pay. So it is going to be the EBIT times 40% tax rate, and then you just drag it all the way. And then you have the net income. All right, so this is the EBIT minus the taxes. All right, and then you just drag it all the way. All right, so after you get the net income, you will need to do the operating cash flows. All right, so the operating cash flow is fairly simple. You just use the net income added by the depreciation. So depreciation was deducted at the beginning, but since it is a non-cash item, so you need to recoup it. You need to add it back to cancel the non-cash effect. So the rest of the items here are all 100% cash. All right, and then the next thing you need to do is the inventory. So the inventory here is a 10% of next year's sales. So that's fairly simple to do. So you use a 10%, but you need to start from year 0 because next year will be year 1. All right, and then you just drag it. All right, so that's the level inventory you need to establish at the beginning of each year. All right, and then you need to get the cash effect. So we call this a change of net working capital. That's the official name for it under capital budgeting. And so from $0 worth of inventory to $7,500, you actually spent cash on it. So the cash effect is negative $7,500. All right. And then your inventory can maintain at the same level for the next 2 years. So you will use the beginning inventory minus the ending inventory. So there's no change for it. Or you can use the end inventory minus the beginning inventory. All right, so that's a change of inventory. If inventory increase, you need to spend more cash. If inventory decrease, you will receive some cash from liquidated inventory. So you need to put a negative sign in front of it. All right, so right here you got 0 values, but for the last year, you actually have a liquidated all inventory of $7,500, and when you liquidate, your inventory reduced by $7,500 negative, but you put a negative sign in front of it, so that's going to be a positive cash inflow. So when you sell your inventory drop from this level to 0, you actually receive cash for it. Okay, and you also need to get the terminal cash flow. So what is the terminal cash flows? It is the $30,000 actual sales value you sell the machine for, and you also pay the capital gains tax to the IRS for the additional profit you made. Okay, so this is the terminal cash flow. So for capital budgeting, there are 4 components, which are capital expenditure, operating cash flow, the change in inventory, or the cash effect from change in net working capital, and terminal cash flow. So you will get the free cash flow here, which combines the all 4 items. Okay, 1, 2, 3, and 4. Even though for certain years some component is missing, you still need to put it because eventually you're going to drag them all the way up. Alright, so this is your free cash flows. And then you will need to calculate the NPV based on the 10% cost of capital, which might include the inventory cost. So, which might include the interest expenses. So you will need to put NPV 10%, and then you're gonna put value 1 to value 3. Don't put value 0 in there, but you put a value 0 outside the NPV parenthesis. So this is the NPV of the project. And for the IRR, it is a fairly simple, very straightforward. You just use the IRR formula, and then you circle from cash flow 0 to cash flow n, the last. Then you hit enter. So you got a 15% or 15.45%. So which means based on the cash flows, you can get an annual return of a 15% on average. And that's basically the end of this quiz.